Ladies and gentlemen, welcome to the Board of Advisors podcast. Once again, we have another amazing member here with us today, ERIK STROM. ERIK STROM with Iron Ridge Capital. You guys are doing an amazing job with not only the acquisition, but the operations and value add exits on all your projects. What are the numbers over the last 14, 18 years?
So we started our first project in 2007, second in 2008, and that was, obviously right before the Great Recession. And since then, we've done 16 projects, including the ones that we bought right before the collapse. We were at 31.4% per year return average over that time.
That is exactly what I like to hear, because that's not normal. But yeah. When you joined Board of Advisors, you guys have been a member for how many years now? 4?
I think we're at 3 or 4. Yeah.
Okay. That is the type of relationship that I love sitting across the table from myself. The whole reason I built BA, and really, it's not even about me. It's about the team. But this is why I love what I do, because I get to form real relationships with guys like you, guys like ERIK, your partner. The members of BA are what make it so important and special for me to invest blood, sweat, tears, and put my heart into it. And, I try to never let you guys down, but you never really let me down either. I mean, that is a showcase. You are an asset of membership. I love to invite people to come and meet you in person, sit across the table, have the conversations, and learn if they're in multifamily, how do they get 31? Whatever. What'd you say again?
31.4.
Yeah, because there's a 0.4 in there.
You can't forget
31.4%. I'm sure they'd like to know, but maybe they're looking for a place to put their capital. Maybe they're looking for a great operator, somebody that they can trust. That's who I want to invite them to have that little chat with, is ERIK STROM.
I appreciate that. Yeah. I mean, that would mean a lot to us. I mean, it goes along with everything that we've done. Everything that we built was done on personal relationships. The first deal that we ever raised money on was in 2007. We'd raised $515,000. And
did it seem like a lot?
It was. I didn't know if we were going to do it. It took a lot of work. It was the hardest capital raise that we had ever done. And I would go to bed some nights and I would think, oh my gosh, is my reputation in this town going to be forever tainted because we tied up a property? And we're talking a teeny property. We're talking 11 units, right?
Yeah.
But I was a broker. So this was my peer group and I needed to show that I could do it. And it was all family and friends. So, these are people like, hey, my mom, my dad, friends growing up, other professionals. And, we did it. And it was very difficult, but to put it into context, now $515,000, that's a phone call, or that's just a check that you write and you take up a building. But in the early days, it was very difficult. You have to have that track record, and you have to build up those relationships. And that took from 2007 until now.
In 27 years, with everything
Pause you guys real quick. In the 27 years, probably just want to fix your coat that's sticking out.
Oh, perfect.
Don't ever let that happen again.
This is my reach here.
That's my hair.
We'll give it a beat. And that's 3.
In 27 years, after everything I've learned in business, investing, making money, losing money, tax strategy, I think I'm in a place where my realization and outcome is multifamily is just such a great opportunity for higher than normal returns, but such security and safety that whether it's my active dollar coming into retirement accounts for tax mitigation purposes being redeployed into something like this, or maybe it's a tech company that I invested in where maybe you win big, I think I would still roll it into this. I feel that once you have something to work with and you understand what's possible with multifamily and the power of compounding those returns and interest over time, it's almost like a can't lose formula. That's my perspective. Operators like you are what make that possible. Why are you, though, in multifamily?
It's a good question. When I was in high school, I was trying to figure out, okay, I had read Rich Dad, Poor Dad, like a lot of people do.
Sure.
And you realize, okay, we need to invest in assets. And, so I was going around trying to find, single family houses that I could, assume an FHA loan for or a VA loan. And somebody just said, hey, you need to have a conversation with this guy, John Bays. And I met this guy. I was going to college, a couple of years later, met him. And he said, hey, go look at commercial. And so I really got into looking at all different types of commercial. And just by happenstance, I met up with these guys that were doing apartment buildings. And I watched what they were doing. And I was like, okay, this is a traditionally safe asset. Dissimilar to like tech, you have a great idea. Maybe it'll hit. Maybe there's a need. Maybe there's a product fit. With apartment buildings, everyone needs a home. It's like medical. Like if you get hurt, you have to go to a hospital. You have a broken bone. They need to fix it. You need someplace to sleep at the end of the day. So as I got into it more, I realized, okay, well, this is great because you can put leverage behind it and you can get a better return that way. There's great tax effects. You can do, accelerated depreciation, cost seg studies. Beautiful tool that, has kept me from paying much in taxes, over the last cycle. You can do refinances, you have cash flow, and then you can sell. And as we got more into that, that's a niche within the real estate market. It's apartment buildings. We're a niche within a niche. So we're doing value add apartment buildings. So we're taking...
That's it right there.
Exactly. So we take a traditionally stable asset, which if you just go buy an apartment, you might get a 4 or 5% cash flow return. If the market goes up, then your building value goes up. We do it a little different. Since every building is based on the cash flow that it produces, every time we raise rents by $100 a month, we increase the value of the building by $20,000. So if we say, hey, we're going to go spend $10,000 on fixing up the kitchens, the bathrooms, raise rents $300 a unit, like we did on the last project we bought, multiply that by the 100 units at the Flats on Handley. That's a $6 million immediate bump in value. So now we have an asset that is backed by being stable. Everyone's got to live there. It's easy to finance. And we get the return at the same time.
As I'm sitting here listening to you, I figured out what you did. You created a lever. You are now able to take multifamily, which has multiple assets within one, understanding the lever of if we do one thing right, it becomes a multiple, and then it just factors into the entire valuation. So you're looking at not only the number of units, but you're also looking at the ability to add value based on your expertise, acquisition, enhancements. It's not about being the most beautiful place in the world. It's about the right type. Until you hit a certain threshold, there's an intersection there, I would think.
Absolutely. And every project is different. So, we've done, relatively new buildings where we'll buy something that was built in 2005. We might throw $30,000 a door into that. We're talking quartz countertops, stainless appliances, the backsplash, washers and dryers and units, really making it
So
nice.
the right stuff, does that factor into ownership cost over time? If you ever sell it, does that really...
It really has nobody's going to go into an apartment building and say, hey, I really like how this looks. It's not like a house. So with a house, you do a remodel and, somebody's going to live there. In apartment buildings, the savvy investor doesn't care what it looks like. To some extent, they may want a trophy property, but what they really want is they want a return. And if it's valued on the cash flow, you're buying an annuity. So if we increase the cash flow, then somebody that says, hey, I just want to come in and have a turnkey project. No stress. I know that this building is operating well. They'll pay a premium for that.
For turnkey.
For turnkey, correct. Now, we're not turnkey people because even though it's stable and it's low risk, it doesn't give us the return. We go look for the ugly duckling and we say, hey, this could be a prince or princess or, whatever. But we're saying if we do the right thing to this property, by putting in this amount of money, we can raise rents to this level. And that's the value add model. There's also different ways to do it. I mean, you can decrease expenses, find efficiencies. But at the end of the day, it's a very simple formula. The higher the NOI goes, the higher the price you can sell it for goes, the more money you can take out on refinance, and the more cash flow you can distribute. And those are your three ways of making money as an investor. You know, I'm either going to get a check once a quarter, that's cash flow. We do a big refi like we just did on Oak Street Flats. And in a time right now where multifamily is about to go through a really rough period, we were able to refinance that and distribute 65% of everyone's original investment back to them. And when you do that, it's tax-free. Now,
But do you find that they keep giving it back to you?
Oh, yeah, all the time.
Yeah. So you can't get rid of the money anymore.
No, and I think that's a challenge because, like I said, it was really hard to raise the money, you know, back in 2007, 2008.
Now you're trying to put it to work.
Now we're saying, you know, I'd say, let's see, last 6 projects, we've oversubscribed within 60 seconds of putting the project out. And it's made it so that we have to have rules where we say, okay, here's how you can subscribe. Because, you know, we can't just call up 10 people and fill up because person 11, 12, 13, they're going to say, how come I didn't get a phone call?
Yeah, you want to distribute the returns across, because what you're doing is creating fault tolerance and volume. Because really, if you're serving a dozen investors, okay, cool, now you're kind of restricted to a dozen. But if you partialize the deal across, let's say, 100 investors, well, really, you actually have 100 containers that if you really needed to flex up on a big project, now you can take down bigger projects. So you've got to spread that peanut butter is what I'm hearing.
We do. And you have to spread it in a way that you're still going to be competitive. So, you know, like within our niche, you know, we want to be above the level that, you know, a small group or a doctor or a lawyer could buy. But we always, at the same time, want to be underneath that level of the institutional investor. We are not going to compete with BlackRock or REITs or, you know, any type of institution that's having money thrown at them and they just need to put it into a product. You know, we're not going to compete with that. We're in an inefficient market, you know, somewhere with purchase prices between 6 and I'd say, you know, $15, $20 million. So we want to buy as many of those as we can. And then we have to pick the timing of the market correctly too. I mean, there are some years we don't buy anything. And, you know, in the past 2-3 years.
I noticed that. You said, no, we're not. We're holding.
Yeah, I mean.
And that's discipline.
It is.
And knowing timing.
It is. But I mean, when you have taken that long, when you came from a background like we did, you know, both Eric and I, we didn't grow up with anything. So if you look at the investment group, I mean, these are people in our wedding, like people that we sit down and we have Thanksgiving dinner with. And then as we've grown that.
This is your community.
It is our community, and we take it really seriously. So if somebody, a new investor, you know, gets into a deal, we know that they're going to be an investor for life as long as we don't screw it up. So you have to be a really good steward of that trust. And, you know, we have no ambitions of riding around in Lear jets. Like, we're doing this for security for our family. Number one, that's it. You know, we're not flashy guys. Eric, you know, drives around in a Ford F-150. I'm in like a 2015 Jeep Grand Cherokee. I mean, we have nice houses and, you know, we've got some toys, but it's not, there's no pressure from us to go do a deal. You know, if we lose out on raising money from investors, that's okay. Because we're going to enter into a market like we're going to be entering into next year, where we can say, okay, now there's a real opportunity. There's some blood in the water. There's some systemic risk. There's some structural problems. And it will be just like when we were coming out of that 08-09 crisis, where all the new money is gone. The competitive landscape is much more shifted towards people that have the capability to do things without just overpaying to be awarded deals. And then we'll have those best returns again. So I look at this coming market as like a chance, like a redo.
So is the question to your investor, are you looking for returns or are you looking for activity? Because I kind of hear you saying,
you can't have
sometimes
both.
we throttle our activity to ensure the returns But it almost requires more trust from your investor because they're thinking, I could put this money somewhere else potentially, which doesn't always mean they're making the smart decision, but they have to be patient like you.
They do. And it's also not my decision. It's their money. They go
Sure.
do whatever they want to with it. But, if we have the opportunity to go back to a market like, 2010, 2011, but now we have, the investor group and the track record, the expertise, the capability and capacity within the management company that we own to take care of things, then we can say, okay, now we can scale. And, the other thing too is that I don't want to say that we're timing a market. I mean, you have to buy the best deals as you see them and the best opportunities. So we're not going to, over the last 2-3 years, we weren't saying, hey, we're not going to buy anything. But we had a lot more scrutiny on what we were buying. So, in 2020, 2021, 2022, it seems like every couple months we're writing these $2 trillion checks. We're having massive government spending. The Fed is throwing a ton of money on the balance sheet. And we have a zero interest rate policy that's on the tail end of 10 years. That is a recipe for disaster.
Well, for an individual like you, it keeps creating the ingredients and factors for perfect storm buying opportunity. And it's like as the storm is rolling in, you're watching it accumulate factors that contribute to your opportunity, knowing that your opportunity is on the other side of it.
Totally. I mean, I moved to Texas 3 years ago. I can sit in my backyard.
Are things bigger there?
Oh, yeah.
They are. They really
Way
are.
bigger houses.
What's bigger?
A furniture store that's like the size of a mall.
But everything.
Everything. But you can sit in your backyard and you watch this hailstorm come in, and it's this really dark, ominous looking cloud, and it's moving right at you. And so okay, well, we're going to get a hailstorm.
What the hell is that?
Yeah, what the hell is that? And then
dad joke.
Yeah,
Got to do it.
You have to.
Yeah.
And then 2 hours later, it's going to be calm skies again.
Yeah.
And so that's kind of what we're looking at right now. Is you can see it coming. But
that's your job in the relationship.
That's my job, and that's why we slowed down about 2 years ago. And I think it was at BA that during our presentation, I told everyone, look, there's no time in the history of fiat currency.
Well, I actually remember this
You
because
do?
we talked about it before your time
Yeah.
in front of the community. And then we actually, you did the presentation, and it just for me started sinking in. And I'm like, I want to exit a few things in my world so that I can actually get over better into your world, because I believe exactly what you're saying.
Mm-hmm. Yeah, I mean, and it happened, and I think that it's going to be probably the best opportunity that we're going to see over the next 10 years. It'll be the start of a new cycle, and we'll be buying up as much as as we can.
Yeah.
So
let's actually highlight that right there.
Sure.
I just got out of a conversation with one of the top land acquisition guys in all of Florida. Okay, I mean big acquisitions, and a gentleman that really has a lot of history in not only development but the hedge fund side of things, the institutional side of things. You're talking big money over here. You're talking fueling the machine, but land fuels the machine because that's where everything sits. You're in the middle. Are you doing any development? Is it only acquisition of what I call dirty realty?
I like that, dirty realty. Yeah, that should be a show.
I actually own the URL, dirtyrealty.com.
Yeah, I like it.
Yeah, we could do something.
Totally. No, like I said, I started, this is 22 years of watching people do things. And development it's good if you have to place a lot of capital because you can create the deal. For me, it doesn't fit the risk narrative of what I want to do. Because the problem with development is you're looking at something with a 2-3 year crystal ball, depending on where you're developing. And I am very comfortable with a 12-month crystal ball.
I see. You've got to have as a sniper, you've got to have a longer scope, a longer rifle, a longer ability to shoot, aim, fire longer, whatever the order is. And your comfort zone and specialty is just shorten it up a little bit. Let's deal with existing structures. Because you actually, it sounds like you like the fact of understanding exactly what you're dealing with.
Yeah, I don't like a lot of ambiguity.
Yeah.
And I don't like betting on the come either way, right? Whether we're betting that things are going to get worse or better, you can develop strategies for it.
Have you had any really crappy projects that just did not get a return?
No, the worst deal we ever did, we bought in 2008. We had an LOI from Washington Mutual, and they collapsed in the middle of the loan, and the loan letterhead came in on Chase letterhead.
Oh, wow.
So we bought that, during that whole Lehman Brothers crisis that was happening while the property was in escrow. We held it for, I'll have to go take a look. It was either 6 or 9 years. It's been a long time. But our worst deal ever was a 15% a year return that we held for, like I said, like 6 to 9 years. That was the worst one we ever did. But we stress test everything. So every deal that we buy right now, I say, okay, what if 2008 happens again? So let's, increase rates 100, 150 basis points, and let's drop rents by 20%. And so that way, can we survive? Because the big thing in real estate, you can't time everything, right?
Is that the main mechanism or lever, is the basis point on a stress test? Because I saw that you went directly to that.
Income, expenses, and interest rate. Those are going to be the biggest variables in terms of, in terms of value.
Yeah.
And where we're headed right now is that interest rates have doubled. And that's why, a lot of these projects are going to be completely underwater. The vast majority of every building that was bought over the last, 3-4 years, it was all done on this bridge debt. These are floating rate loans, right?
You're talking about like just cracks forming in the foundation of these deals everywhere.
Everywhere. And this is a real systemic issue.
I see.
So what's going to happen is, if the majority of all loans taken out were done on floating rate loans, and then the rate at the time was 3%, and now it's 9.5%, 10%, they don't meet their debt service requirements that the bank has. So not only is the loan in default with the current lender, but the loans are coming due because all of these things had 2 to 3 year terms on them, and then you have to pay off the loan. People were okay with that because the way you pay it off,
the balloon is due.
It's a balloon, correct. And so you have to either refinance or sell. But when the rates are at the level that they're at today, the building is worth 25, 30% less.
It's worth less.
There's no equity.
The loan costs more. Cash flowing, impossible.
Totally.
So do you wear a cape when you go out?
A cape? No, I don't wear a cape. I think that maybe I will, 5 years from now when we capitalize on this one.
Yeah. So what I see, you're posturing yourself, your family, your partners, your investors for this perfect storm. Just like Warren Buffett says, hey, we made 12 good decisions over the last 20, 30 years, right?
Yep.
This is one where you think you've got an opportunity to leapfrog wealth and for your investors, your family, really position yourself well long term.
Absolutely.
Yeah. And the conversation that you're looking for is with who?
So, our strategy for this is to start our first fund because we've been doing the syndication model, but we fill up too quickly. We don't fit everyone in. With the fund, you have a couple things. One, you have a bigger pool of capital, so you know exactly what resources you have to deploy, and you can take advantage of distressed situations. So let's say that you're in that bucket where your loan's coming due. You can't refinance it because you don't qualify. The building doesn't qualify for the existing debt. You can't sell it because it's not worth enough, but you got to pay it off.
Well, you scared me.
Yeah. Well,
when you told me, so I paid it off.
Yeah, this is happening everywhere. And if people, if they can pay it off, they will. But let's say that you're in that position and you're like, okay, I've got a little bit of equity left. I can actually just, if we sell it,
sure,
we'll just pay the debt off. We'll walk away. Who are you going to sell to? You're going to sell to a guy that says, hey, in a horrible financing market, I need 3-4 months to get a loan done.
Yeah.
Or you're going to sell to the guy that says, I'll pay you cash, in 2 weeks, 3 weeks. You're going to sell to the sure hand.
You want the transaction done, the money in the bank.
Exactly. You go, you pay all cash for it. You do all the normal due diligence, but you're ready. Like strategically,
How far are we
you
away
have the
from
funds. I don't have a crystal ball, but in terms of what I'm thinking that we're going to really start to see this pick up in Q1 of next year, and we're already seeing it.
So real estate is a lagging indicator,
Mm-hmm.
right? How far?
In a typical market, I think it's usually 6 months. Like
Yeah,
you see something happen in the stock market, it shows up in real estate later. This one I think is going to be, and these are horrible words, this time it'll be different, right? You never want to hear that in investing. But on this one, I think that, we saw tech get hit really hard when interest rates went up. That was, the first shoe to drop. Commercial real estate will be number 2. There may be some issues with corporate debt, but it's just how it was financed. There's $1.5 trillion worth of debt coming due by 2025, and much of that cannot be replaced.
With the velocity and speed that the interest rates were increased, does that make the lag longer? In my mind, I think it would.
The lag in terms of what? The lag between
Of the
what and
indicator
what?
of like this showing its head.
Yeah. It's part of buyer problem and it's part of bank problem. Yes, in terms of how fast and how high they went, but the common theme when you talk to buyers over the last couple of years that have bought is pretend and extend or stay alive until 25. And the hope is that we'll get pushed into a recession, that the Fed will lower interest rates, and that if they can just stay alive, then rates will be lower and they can refinance or sell their property.
I feel like they raised rates so fast that when this hits, it's going to be harder than ever for some of these less seasoned people to hold on, which I think there are more of them than ever. And so let's fast forward to that bank, it starts falling apart.
Mm-hmm.
But you also now have the rapid reduction of rates to begin starting to give opportunity to save the economy.
Yep.
You have growth assets or on-risk assets that start getting a lot of attention. So you have capital that you need to go back into this opportunity, but they start putting it into growth assets, which I almost feel like it would make that even more of an opportunity for you who is well positioned.
I think so. And that leg it'll take a little bit of time. And, certain things have to happen for them to lower those rates. You have to have either high unemployment or some kind of a recession. But I don't think that organically there's any reason for rates to go down in time to save a lot of these deals. We see about 2 to 5 deals a week right now where people are scared. They're trying to sell their properties just to get out from under the debt. And on the institutional side, you're seeing a lot of these, big funds just handing the keys back to the bank really quickly, like as fast as they can. Here, you take it. Because they know they're just going to raise another fund and start buying on the cheap. To me, I think that sucks.
Yeah.
Because the LPs in those funds, they're going to get screwed. So we don't have the opportunity, or ever the desire to say, okay, whatever, we're just going to take a wash on this, pool of assets because we're going to make it up on fund 2.
Yeah, because your name is on it. Their name is not on it.
It is, and they don't care. But that's kind of a red herring. But there will be a lag time, and then the problem is even if rates, let's say that rates go down, in 25. Maybe that'll help some people on the refinance, but it'll take longer on the sales cycle for people to sell buildings because there's no comps.
I have a great track record of being wrong,
Mm-hmm.
which helps you to be right.
I'm wrong on the stock market all the time, consistently.
I think that rates will be reduced strong and fast or urgently starting probably Q2 of next year.
What's going to have to happen for them to reduce them, though?
I think there's a lot of pressures. There will be more pressures especially politically.
So-
Good.
So you're thinking that, basically the current administration is going to say, hey, we need to get reelected. They're going to put pressure on Jerome Powell and say, drop the rates.
I think that Jerome is usually late on everything.
Mm-hmm.
He's going to resist, but I do think he's going to give in.
I could make a really good case for that happening, and that's the tough part about all of this, right? Is that we don't have a crystal ball. So for us and in the current portfolio, it's saying, what do we know today? And what is our tolerance for risk if rates continue to go up? What is our opportunity when rates go down? I'm of the school of thought, similar to you, that I think that rates will go down. I don't know if it would be before the election. I think that for me, the only thing that I can be truly solid in is that if unemployment goes up and we go into an actual recession, then they've already shown what they're going to do. And the QT will turn into QE, meaning that they're buying up, more assets to put on the balance sheet and that they're going to print money again. Because, they've shown that they're very activist, an activist Fed. We had these bank crises earlier in the year, and they made a program to basically bail out all these regional banks. So they're willing to do things now that they never would have done in 2008. And it's probably good because in 2008, had they done some of those things, it probably wouldn't have been a crisis to the same magnitude. So, I don't know how it's going to happen. What I do know is that on the ground today, we're seeing so many deals every week where these are priced 25% cheaper than they were the year before. There's fear. People want to get out. And we're seeing it also on the property management side with that business that we opened. We're taking on a lot of properties from unseasoned sponsors. People that were doing their first, second, third, fourth deal. They had not gone through a recession before. They thought that things were just going to continue to go up. And we have serious conversations with them. We have to say, okay, well, here's what the situation is going to be if we don't drastically alter your business plan. Because you can't just wait for anything to go up. That organic rent growth, it's gone. So you're going to have to put some money into this asset. You're going to have to raise the rents. And even at that point, you're barely going to squeak by on replacing the debt when it's due in 6 months.
Money, baby.
Totally.
And so how far off is the fund? Is that active now?
No, it's not active yet. I think that we'll probably be ready to actually start going out and raising money for it in Q1 of next year. The idea is that...
Are you acquiring between now and then?
Oh, yeah, absolutely.
Are you raising capital in the traditional manner that you always have?
Traditional until we get there.
Okay.
We look at a lot of deals right now. There's still a disconnect between buyers and sellers. I think that sellers right now are trying to kind of ostrich. They're sticking their head in the sands and they're hoping that something is going to get better. But there are a lot of people that are realizing that they're in a jam.
Yeah.
And they just need to get out. And I mean, that's a real tough thing for people, especially after a 10-year bull run in this market. They just have to believe that things are going to get better. But the sad part is,
what's the smartest
they may
exit
not.
for somebody in that position? Sooner than later?
Absolutely.
Yeah.
Because like I said, it's not even about just rates.
Which is the hardest thing to do. Because they still are trying to figure it out.
Well, I mean, that's what we did. We stabilized the entire portfolio, refinanced everything. I mean, a year ago, we were kind of pinching our nose when we signed the documents on a 4.95% loan because it's like, oh, it's so high, And today, I mean, that's a great loan because, I mean, you'd be getting something, 6.5%, 7% for the same product. And we're looking at it, as, okay, you got to stabilize the ship. You may not like it, but yeah, you got to go do a loan at 6.5%, drops down your cash flow a little bit. Fine. Do something creative to give yourself the flexibility on a prepay structure so that in 3 years, if rates are lower, you can get out.
Now, are you doing any type of consulting, education, conversation with people on how to do that? Or is that really not of interest?
Not a ton of interest just because there's so many hours in the day. If people want to hire us, we'll help them.
Sure.
In terms of like just doing the asset management or property management.
You would rather them call you and say, hey, I have a property.
We know how to do things the way we know how to do them. So if they had a problem and they said, okay, I want to get some advice. I'll have a 20, 30-minute phone call. We'll do lunch,
Sure.
fine. If you want us to fix it, we're not going to consult. You're just going to have to give us control over the asset, and we'll fix it.
Yeah.
And if we
is
don't
that-
think
is-
we can
is
fix it,
that
we'll
through
tell you.
management?
It's through management and asset management.
Well, that's not actually a bad invite or strategy
Yeah.
for you to acquire more properties, they to hand it over to a real pro if they think they're underwater, and potentially partner with you on
We kind of thought about that. There are a bunch of groups out there right now basically doing, it's like this, how would you put it, last in, first out capital. So you went and you did a
Right.
deal.
Right.
You need some rescue money. And we looked at the structure on it. The problem is that the deals you would really want to do that on, you're basically becoming a hard money lender that plans
You're building
on
your
taking,
house on the sand.
Yeah, and,
Yeah.
and like the way to really make it work is to take the property back, and I just don't want to do that.
Yeah.
You know, I mean, I don't want to begin a relationship with somebody and know that the entire time it's like a hard money loan and
Yeah.
I'm trying to take your property.
Yeah.
I'm just not
The payday
interested.
loan. Yeah. Designed to fail.
Yeah.
Win for you, fail
No,
for them.
we want good relationships that we can build off of, for the next 30 years.
Yeah.
So,
Yeah. Beautiful. So really what I'm hearing is you've got a great system. You understand your lane, what you do, your market, your asset, your process, and you're fair, firm, and consistent. It's not exotic,
no.
but the end result sure does make a family feel better. It makes an investor feel better
It does.
for legacy, for estates, for something that many times a lot of people chase. What is that new thing out there?
Yeah.
Sometimes the hammer and the nail just get it done.
We'll do this. So you like make a Excel spreadsheet, a graph, put it on a napkin with a pen, and like when you go home tonight, take a number of what you would invest in a typical deal in a year. So let's say it's like $100,000.
Let's use 100.
So take 100. Now, if you could consistently double that every 5 years, just draw it out, And if you look at like a 20-year-old, you put in 100 grand. 25 it's 200, and 30 it's 400. At 35 it's 800. At 40 it's 1.6. At 45 it's 3.2. At 50 it's 6.4. At 65, that's $12.8 million, right? Off of 100 grand when you're 20. Shows two things. One, start early. Two, never lose money. But three, if you can double your money every 5 years. Now think about people that have like a decent nest egg, or they're exiting something, or they've done like some type of liquidity event. Do you want to go back into, do you want to put all of your eggs back into something that is, more speculative, and you've got a 10-year, time horizon where you're going to either make a boatload of money or none? And you can, that's totally fine, but maybe take a little bit, diversify it into something else, and say, okay, is doubling every 5 years worth it? And I don't have to rush, because I've looked at what we've built over the last 20, what we have today, and if we just double that every 5 years, I'm not going to be worried about money when I retire.
Mm-hmm.
So there's no urgency in terms of, I have to go make a ton of money today. The urgency is, don't screw anything up.
Just keep doing it.
And keep solidly picking away at the best deals that you can find with real discipline. Mm-hmm. And stick to what you know.
I think what you just said, I know when to shut my mouth, and it's right now. I want to invite everyone to meet you, ERIK STROM. You've got a great partner. But today, you're actually ministering to the listener about where we're at, where we're going, something that isn't fancy but is real, consistent, doable. I'd love for individuals to meet you at the upcoming meeting. I'd love for them to get on platform boardofadvisors.com, and I'd love for them to actually learn about how they can get involved with you, what you're doing. Like you said, even if it's 100, 50, 250, whatever it is, maybe they have a lot, maybe there's a nest egg, maybe they want to actually transition their strategy. But I find enthusiasm and I get real energy from creating the opportunity for individuals to engage with what I call an asset like you as part of Board of Advisors. So if you were to give them a way to connect with you directly, how would you do that right now?
I would just say by phone. I'm
Yeah.
old fashioned. Let's have a conversation.
Sure.
And, then we can go over our track record, kind of our philosophy, see if there's a fit. And these are long-term things. Like, this is not something we have nothing ready to go right now. Next year we'll have the fund that'll be ready. But, whether it's a small amount, a large amount, whatever it is, it doesn't matter to us. We're looking for the relationship that we can slowly grow over time and just add to the existing pool of people that we have. And we can all be sitting at the same table 25 years from now.
Beautiful. With no stress.
Security
Security.
and no stress.
Let's make it. Let's keep it. Let's grow it. So we're not broadcasting your actual phone number. If you go to boardofadvisors.com or let's go to bainvite.com. So bainvite.com, and you just type in ERIK STROM or multifamily or Iron Ridge Capital, any of those things. We will get you in touch with ERIK. And I am more than enthusiastic to advocate for you. I really think that you and ERIK are a home run place to park cash when it's critical for retirement. Because a lot of people, they're underestimating the weight that many times age brings on their body, on their finances, on everything. And it usually requires more than they thought. And I think you can put people into a position that secures that. I like the word security. So thank you for your time today, ERIK. And always, I just enjoyed listening to you. So thank you for your time.
Thank you. I mean, this has been a lot of fun. We love being a part of BA. We're really excited. I'll be there on the next meeting. And I like doing more of this. You've cultivated an amazing group of people.